Are we going to have to answer the same question on the next mid-quarter call and see if we're right or wrong?
We may. I guess that's part of it, right? So let's talk about, we kind of talked about a lot of questions and given some answers. It's been really good. Where do you guys see it? Obviously, no one has a crystal ball, right? We don't know for sure, but where do you see things going? And this is, again, another client question we can kind of wrap up with. Where do you see things going by year end? Maybe a little bit beyond year end. We don't know an exact date, but kind of what are the things you're looking for as the year progresses?
You know, I'm actually thinking that, maybe I'm just a general optimist, but I'm thinking a lot of the pain. If I had to put a number on it, hold my feet to the fire, I'm going to say 80 north +% of the pain feels like it's priced in. So as long, I've tried to explain to folks before, news can still be bad and markets go up as long as they're as bad as expected or even less bad than expected. News can still be bad. I try to explain to clients that the lowest day of 2020 in the stock market, the lowest day when we went through COVID, was actually the exact same day that the United States had its first reported death. And that's when the market bottomed. And so every single day from that day forward, people continue to die and people continue to get sick, but the market went up. Why? Because it wasn't Ebola. It was less bad, even though it was terrible. And so when I'm looking at right now, when we're looking at the probability of World War III versus possibility, pray to God that it's going to be less, but odds are it will be. Inflation probably isn't going to be 20%, like some people fear. And it's quite possible. I think the first spike to this market could be when inflation is under the estimate. And then I think the Federal Reserve may not have to raise rates quite as hard as a lot of people fear, because a lot of the markets itself have kind of controlled the demand and controlled some of this inflation, because people are just so scared. So they're not spending as much money, or if their financial assets are down, they're not spending as much money. So I think it's very possible that the markets are higher than where they are by year end compared to where they are now. And especially bonds. I think you'll get those yields that we're seeing on the bonds right now are starting to get very attractive, especially for long-term investors.
I think too, like you said there, Jason, as far as, your fear baked in and people stop spending, right? So we've had clients and conversations with people, that are fearful. And so maybe they aren't spending a lot as much. And so, like you said, some of the things we're looking for is inflation to kind of come down. It's not going to go from 8 to 2% overnight, right? But just kind of the less increase.
But it doesn't even need to. If it just goes from 8 to 7, people are going to, 100%. Market's going to go to the moon if it goes from 8 to 7.
And that's a market
less bad.
And that's a market fix in itself, right? And by people spending less money, it allows the product and supply chain to kind of build back up, because there's less spending and less demand for it. And so I think over time, I agree that I won't ever predict and say that we've hit bottom by any means, but I'm in the same camp that I feel like most of the pain is behind us, and the market has already kind of priced in a lot of the negative stuff that we're talking about might happen in the next month or two. The market's forward looking, as we talked about. So I'm not willing to go out on a limb and say the market's going to be positive by the year end, but I do think that we've neared bottom, and I think that the portfolios will be higher at the end of the year than they are today.
Are we going to have to answer the same question on the next mid-quarter call and see if we're right or wrong?
We may. I guess that's part of it, right?
I'm glad you said that, though, Kyle, because most of what we deal with as an entire economy is self-correcting. And when you talk about, people are a little fearful, portfolios are down, maybe housing prices are starting to slow down their growth, then and then folks start slowing their spending, and then there's not as long a lines at the grocery store, and suddenly prices are able to come down a little bit. When there's so many people, Adam mentioned this earlier, when there's so many people and so many dollars chasing so few goods, if you can just abate that a little bit, prices start to settle themselves, inflation comes in, checks in lower, and then you have a situation where suddenly, like you said, maybe the Fed doesn't have to raise all the way through the end of the year. Maybe they don't have to keep cranking it in. And so some of these things will self-correct themselves, I really believe as well.
Yeah, I think that's good. We'll probably close with that. Just wanted to thank everybody for taking their time to be on here. I think we went through a lot of good topics. Hopefully questions that maybe you have that we're having conversations with other clients about. You get get a view into how we think about things, and like I said, the way we're answering various questions we're getting from other people. But I think maybe the biggest takeaway is everybody. This is a private client business. Everybody's in a unique situation. We talked about a lot of different situations here. People that are in retirement, pre-retirement, younger, need money, don't need money, more risk, less risk. And the uniqueness of what we do is working with people individually. We can't control the market. Couldn't control where it's gone in the beginning of 22, and won't be able to control where it goes the rest of 22 and beyond. But we can analyze your situation and set it up most advantageous for you. So give us a call if you have personal questions. Otherwise, we'll try to do this more often, and hope you enjoyed it.
Thanks, guys.
See ya.
Thanks, everybody.
All right.